Una nota, si prefieren escuchar esta presentación en español, pueden hacer clic en el link que está dentro del chat de Swapcard o en la descripción de esta sesión. Welcome to our talk, A Stronger Lifeline, Behaviorally Informed Interventions to Improve Financial Resilience of Gig Workers and Entrepreneurs in Latin America. Thanks for being with us today in Financial Inclusion Week. Next slide. I'm Luz Gomez, and I lead social impact activities in Latin America and the Caribbean for the MasterCard Center for Inclusive Growth. I'm joined today by Hans Frech La Rosa, a senior behavioral researcher at the Common Sense Lab, which is part of the Center for Advanced Hindsight at Duke University. Common Sense Lab builds solutions that aim to increase the financial well-being for low to moderate income people around the world using the tools and the methodologies of behavioral science. And we've been working together since the height of the pandemic in late 2020 to see how to drive more financial resilience among users of digital platforms, specifically independent workers and micro and small businesses. Next slide. I know this has been a theme of the week here at Financial Inclusion Week, inclusive growth in a digital era. But I wanted to first do a little context setting to illustrate the imperative of engaging with digital platforms. First, I think we need to consider the size of the gig economy globally. Transactions are projected to grow to 455 billion by next year. We've been working on this project in Latin America. And as of 2021, over 400 million potential e-commerce users were online across just 17 countries in Latin America. And the drivers of this tremendous acceleration, obviously the pandemic played a large role as well, were due to existing factors like evolving societal attitudes around P2P sharing and increasing digitization rates in developing countries. And I know we've heard some of that over the past few days. Consumers are more frequently turning to online channels and transaction methods. One study found that more than 50% of consumers in Latin America said they don't want to patronize companies that don't accept electronic payments. So in our region, the gig economy and the use of digital platforms are also playing a major role in starting to formalize the employment of many workers who previously labored only in the informal economy. You can go to the next slide. So you can see some of that data play out here. You can see the regional share of independent workers with East Asia and Latin America leading the pack. I think that graph really underscores the importance of working with workers and small independent businesses. But while it started before the pandemic got underway, there was already a 30% increase in app downloads. But through COVID, there was an 81% increase in delivery platform usage by restaurants in Latin America, as reported by the Inter-American Development Bank. So again, despite the lifeline that digital platforms can provide for independent workers, financial cushions are thin. If anything, I think the pandemic over the past few years have really laid that fact very bare. You could see the hustle of independent workers. It's very palpable. I'm not sure if folks can see the sign here that I posted a picture of that a colleague took in the back of a rideshare driver's car, seeing if riders wanted to purchase some candy to support their son's education. So I think that really just drives home the point that workers continue to mix both formal and informal income streams, and digital platforms are sort of in the mix as well in this dynamic. Next slide. So again, just to hone in on our region in Latin America, 25% of gig workers in Latin America rely on gig work as their only or primary source of income. But here's the critical issue. By and large, many workers, especially those that are low income, have low financial resilience. And so, data from the last Global Findex in 2018, before the pandemic, showed that only 41% of Latin Americans could access funds to cover a financial emergency. And if you looked at just the poorest 40%, only 26% could access funds to cover a financial emergency. So many of the current challenges of low resilience aren't being addressed or necessarily solved by platforms or governments. So our work with Common Sense Lab, as well as the Inter-American Development Bank Savings Laboratory, which has been doing some great work on this topic, it seeks to strengthen the levers of financial resilience. And so what are those levers? Here's four we wanted to talk about today. The first is around generating income. So income volatility and low financial stability is a challenge shared by digital platform workers and entrepreneurs. While the rapid expansion of these platforms have become a source of income for many in the region, how do you maximize income and stability while still preserving flexibility? The second is saving for emergencies. I just mentioned some of the Findex data. So while there's some indications that savings in the region is increasing, many people still save very informally and still aren't prepared for emergencies. Then there's savings for the longer term. In Latin America, the majority of workers, about 130 million, aren't actively saving for retirement. And this is really concerning for low-income independent workers in particular. Only 1 in 10 save for retirement. And even middle-income workers are challenged as well. Only 1 in 3 save for retirement. And finally, holding insurance. Basic health coverage has increased in the region over the last decade, and that's been primarily led by subsidized government systems. But worker-related protections like unemployment benefits, disability, property, or life insurance is still insufficient among independent workers. So with that context setting, I'm going to turn it over to Hans, our resident expert on behavioral science, to give us a landscape and some of the thinking on this front. So over to you, Hans.
Great, thank you so much, Luz, and thanks to everyone for joining this session. The context that Luz described, which is has been the focus of our work with the Center for Inclusive Growth in the past couple of years. From our perspective at the lab, there's many ways of addressing these different challenges. There's many efforts already being done by financial organizations, by different groups, by platforms themselves. But one of the elements of that these challenges also have are sort of like the behavioral decision-making aspect of it. Every time we are encouraging people to save more, to generate more income, giving them additional tools and so on, we're asking people to make different decisions, to exhibit different behaviors. And there's sort of like an intrinsic complexity behind those decisions and those behaviors that us at the Common Sense Lab have been researching for the past 5 to 6 years in the context of financial decision-making. Our work is mostly focused on trying to understand why do people make different decisions, what drives people's decisions makings, and how we can incorporate those lessons into product design and intervention designs, so that in the end, we're fostering better financial resilience by understanding and sort of like nudging those decisions and behaviors that we want people to make. And in the context of gig platforms and digital platforms such as marketplaces, gig work platforms, we've been exploring them and trying to understand what are the main behavioral challenges that workers have to face when they interact with these platforms in their way to improving their financial resilience. And the 3 most pressing ones that we found in our review were, the first one has to do with how many choices workers have to make in these platforms in order to access the different benefits that will support this safety net that Luz was talking about. How do they struggle with planning for future income, planning for work hours, which may end up leading to reduced levels of income and not able to maximize the gains that they can get from these platforms. And lastly, the struggles that they have and that most of us have for forecasting and preparing for the future and having sort of like a stronger net for our future. So in the next couple of slides and during the session, I'm going to walk you through some of the elements we've identified in each of these challenges and some of the behaviorally informed solutions that we have been thinking on, and towards the end, how we're trying to test them and explore them in more depth in the region of Latin America. A first element to sort of like put us in the context of behavioral sciences here, what makes this approach unique is that traditionally different interventions, different efforts have put the focus and the lens on the individual whose behavior we want to change, the people we want to help directly. So most interventions that we see in the financial domain, for example, focus on providing more financial education, giving people more information, organizing different training sessions, and lots of efforts that have different levels of impact and for different people. But one of the challenges we find with this approach is that it puts most of the burden on the actual individual who's already struggling with many decisions, with many elements of the environment, with many complexities, while trying to juggle these different work arrangements. So what behavioral sciences do is tries to open up the scope a little bit more and see, okay, we're not just going to be looking at this individual person and what's going on with this individual person, but what are those elements of the environment in which this person is making these different decisions that could be influencing, either for good or for bad, the decisions that this person end up making. And in this example, one of the key examples we use, for example, is if someone decides to skip a medical appointment at some point, let's say I need to do my annual checkup and I decide to skip it, it could either be explained by me directly not deciding to go or not being motivated enough to go, or it could be the fact that there's so many things happening around me. I need to juggle family pressures. I need to juggle multiple jobs. I need to also make decisions about other aspects in life that in the end, this appointment decision ends up deprioritizing and skipping off. And in the end, I end up not going to my medical appointment. So the key takeaway here, and that is going to guide us through the next set of slides, is that when we look at these different behaviors that we think will drive financial resilience, we're trying to look about what are all the elements of the platforms people interact with, the environments in which they work, the other decisions they're making at the same time, and how we can improve that environment in order for people to be more likely to make the right decisions and to exhibit the right behaviors that would drive their financial resilience, rather than putting more, giving them more information or putting more of the burden on themselves. And the approach we use at the lab in order to identify those insights, to test these different interventions, and to then aim to scale them up, follows these different steps. We rely very much on the experimental approach. So what we end up doing is we partner with different platforms, and we've been working with about 3 to 5 platforms so far in the past 5 years. We identify one key behavior that we want to change, whether it usually aligned with those 4 goals that Luz outlined before. So helping people generate more income, save more for the short term, for the long term, or accessing some form of insurance. We identify one key behavior we want to change, aligned with one of those objectives. We understand it, we explore it, we use different tools for it. We design an intervention that is informed and backed by the literature of behavioral sciences. And then we implement it and test it in the field. And this is the key component of the approach that we've been using, because most of the times what we are seeing is that what works in the lab, what works in a more academic setting, not always translates into the actual field, where other complexities come into place, where it is much more messy, there's much more barriers to overcome in order to implement different interventions. So testing these ideas in the field is the key component to know actually what works, what doesn't work, and how much this can be scaled up then to other platforms and other players in the same field. So with that, I'm going to start walking you through these 3 different challenges that we've outlined and some of the intervention ideas we've been thinking of. The first one has to do with how many choices and how this is preventing workers from accessing different benefits. So just as an example, if we compare the reality of independent workers and the reality of typical employees, typical payroll employees, if we can imagine them, independent workers need to choose their working hours, how many hours they want to work every week, and this is based on other responsibilities that they have, how much income they want to generate, how much demand there is for the different products or services they offer, whereas a typical employee usually has a fixed net number of working hours and a fixed schedule every week. They don't have to make any decisions around that fixed schedule. Independent workers also need to choose and care for the necessary sort of like work equipment that they require. Drivers need to worry about the cars and choosing which one they want to use, how they want to take care of it, what parts they need to replace, bicycles, motorcycles for delivery workers, phone for most of them to be engaging with the platforms. Whereas in a typical employment setting, employees have that equipment monitored and provided by designated teams within the organization. So that's one less thing people have to worry about or make decisions about. They also need to choose what benefits and what services they want to incorporate into their independent work arrangements. Do they need to take on an insurance or not, and which provider they need to use, which plan they need to choose from. If they decide to save for retirement, do they have the opportunity to access a retirement account? And if not, what are the other options they can use in order to save for their retirement? All these things are things they need to consider in the particular environment in which they operate. Whereas for typical employees, these benefits have already been curated by an HR team. It also follows specific employment regulations, and they don't have to make many decisions around those benefits. And the interesting about this is looking at a survey, at a research that IADB did with Uber drivers in Latin America. 66% responded that one of the main reasons why they chose to work in a platform was because of this flexibility of hour and flexibility of decisions they have to make. So for us, what this leads us to think in the domain of behavioral sciences is what we call, there's a paradox of choice. And this is a phenomenon that has been studied in many examples that we think is very, very interesting, which means we as people are attracted to settings that gives us many options. We are motivated and enjoy the autonomy of making decisions or choosing between different options, of having all these opportunities. But it's actually easier for us to make a decision when we have a more restricted set of options. The more options we have, the more attracted we will be to this particular setting, but the harder it will be for us to make a decision in the end. And what research has shown here is that people may end up paralyzing and not making any decision at all when they have too many options to choose from, and so on. So it's a paradox that this is a setting that clearly satisfies many of the motivations and needs that gig workers and independent workers have, but at the same time could be putting them in a position where they don't have the necessary environment, or they have too much of a broad set of choices in order to end up making a decision and choosing the benefits they need for themselves. So what can we do with this setting, and what has research shown to work in this particular setting? Making these key behaviors that we want people to make automatic and simple is one of the most robust suggestions and interventions that the field of behavioral sciences has explored. To give you one example, this is evidence from research that a retirement company has done in the US, and what they consistently find is that when we look at retirement participation rates, the biggest difference that they can identify is that those organizations that offer automatic enrollment, meaning that by default, they enroll people into retirement plans, into retirement savings programs, tend to have much higher participation rates than those who offer a voluntary enrollment, or what we call an opt-in enrollment in this case. So this translates, so for platforms, this translates into how can we start making some of those benefits and decisions sort of like the default decisions for many of gig workers, no? Setting up short-term savings or emergency savings plans by default, setting up retirement savings by default, and so on, so that we simplify those choices that they have to make after joining a platform and while they juggle different priorities. And the second recommendation, because not always, we know that not always things can become a default, or we cannot always automatically enroll people in different programs. A second strategy has to do with simplifying that decision-making process. And this comes from evidence we did with a fintech called Capital in the US. Capital helps people set up different automatic savings rules and choose different savings goals they want to save towards. So in this case, the concern was this was in the middle of the pandemic, and we were thinking, okay, this could be a good opportunity for people to start saving for an emergency. So what we did is, instead of during the onboarding process, we gave them two different options of savings goals they could set up, one with a goal of $100 and one with a goal of $500. And what we found is that regardless of the amount, people who were prompted to choose between one of those goals instead of selecting whatever goal they wanted, were more likely to choose this goal and start saving for one of these emergency savings goals. So that's a second option that platforms can start incorporating into their work as well. How can we maybe give them simplified sets of options for people to start saving for an emergency, for car maintenance, for a new bike, if it's the case of a delivery app, and so on. And these are things that can be embedded into the platforms as well. The second challenge that we've identified and that we mentioned at the beginning has to do with, the first one had to do with people having too many choices and this preventing access to different benefits. The second challenge that we identified has to do with how people plan ahead and how people basically determine how much they want to work and how much income they want to generate from these work arrangements. And that decision, based again on this evidence that people are attracted to the flexible hours, to the flexibility that these platforms provide, those decisions we could think come from how much available time people have, how they juggle different responsibilities. But what evidence also shows, and this is evidence that has been shown since 1997 in a study that Richard Taylor did with taxi drivers. It has been replicated now recently in 2019 in the US with gig platforms, is that people tend to set up for themselves different income goals. And those income goals are what end up driving the decisions around how many hours to drive, how many hours to work on a different job. And this seems like something reasonable, something that could be good for us to have. We all have a different goal, and that helps to sort of like make the decision, simplifies the decision on how much we want to work. But the challenge with this is that these different goals may also put us in a position of not maximizing the hourly income or how much money we can earn in these different settings. And the typical example that the taxi drivers and ride-sharing drivers has to do with days in which there's high demand and days in which there's low demand. So if people had a daily income goal of, let's say, $100, I could achieve that goal in a day with high demand, just working a few hours, or I could end up working many hours on a day where there's low demand, in both days achieving my $100 goal, but not necessarily maximizing the hourly rate or how much effort I have to dedicate in order to achieve that goal. And that's just because we have arbitrarily chosen that goal for themselves. And what this research finds in general is that people continue to have those arbitrary daily income goals that help them plan ahead, but are not helping them maximize their income. What people could be doing to maximize that income in this case is working a few additional hours on those days where there's high demand and fares are high, and maybe working a few less hours on those days where there's low demand, fares are very low, and then might benefit from using that time for something else. And the other challenge that this particular pillar has is that we, in general, as people, we are bad at estimating our incomes in the future. We typically plan by overestimating how much income we will have in the future, how many hours we will work, and this is particularly important for week workers. And what researchers find is that when they ask them and they compare the real income they generate and the real number of hours with what they predicted, they see that they typically overestimate that income and those hours by about 20%, which means that if they are making plans for the future in terms of what they need to spend in the next couple of weeks, what they need to save for in the next couple of months, if they are overestimating their income, they're not making realistic plans in terms of how to achieve those income and savings goals. And one of the behavioral principles that explains what's happening here, and that we see it in many different domains as well, is what we call anchor. And when we're trying to assess or make a particular decision, we typically anchor or guide ourselves from the first number we see or that we remember and that is more salient to us. So if we say we have an income goal and we're trying to decide how many hours to work today, we're probably thinking of that income goal and we're not thinking about that hourly rate that we are generating during the day, and that might say, oh, maybe this is the biggest opportunity to work a little bit more and earn a little bit more, and maybe work less on the next day, and so on. So one of the challenges that we want to work on is identifying what are those anchors and how can we help people, particularly gig workers, reframe or redesign those anchors in order to make better income and better work decisions. And that's what drives us to the second proposed solution here, which has to do with how can we help gig workers establish new goals and establish new reference points in order to make better income and work-related decisions. One of the studies that the lab did a few years ago, this was with a fintech called Steady, and it's a fintech that worked with gig workers in the US as well. Knowing that income targeting was one of the challenges that gig workers had, and that they were probably making their decisions to work on based on these arbitrary income goals and not based on the recent sort of like performance. They use different messages at the beginning and at the middle of the week, so on Mondays and Wednesdays, to remind people of reviewing their sort of like their progress, their income progress from the past few days and from the past week, and using that to redefine and change their income goals, so that they were basically reframing that anchor that they had, and now making decisions based on a new savings goal or on a new income goal with more updated information from the previous week. And what they found in this study is that these interventions, sending people these messages and helping them change their goals, led to about a $7 to $20 increase in their weekly incomes, which translates to about $80 a month in increased income. So just by helping people reframe the goals and redefine the goals that we have arbitrarily set for ourselves, we can be in a better path to generate more income without sacrificing other elements of our day-to-day. And in a second study, this was not done by us, this was done by a different group of researchers, but we thought was very relevant for this topic. Was done in Mozambique with small firms in the Great Maputo region. And in this case, what researchers did is they focused on those companies that were underperforming, meaning those small firms, small businesses that were performing below sort of like the average of the particular city they were studying. And what they found from this group of firms is that 76% of them thought that they were performing better than their peers. So they had seen different sort of like performance indicators from themselves, and they thought that they were performing better than their peers. So what in this case researchers did is they basically use a concept called social norms, and they share with them how they were actually performing in relation to these other firms in the same city, in the same space, using different demographic characteristics, using different sales data that they have gathered from all these firms, and just showing them the actual data and reframing sort of like that performance number that they had from themselves, or that performance belief that these firms had for themselves, led to reducing this performance gap by 43%. So what they found is that these organizations that were firms that were underperforming, they saw how they were actually performing with in comparison to other firms, updated their beliefs, improved their pricing strategies, improved how much time they dedicated to the business, and were able to catch up with the other group of firms. So in both cases, the interventions were focused on identifying what is that number, that sort of like piece of information that is driving people's decisions at the moment, and how we can change it in order to improve the performance of gig workers or small businesses here. And lastly, the third challenge, which we think is one of the most relevant as well, not only for gig workers, but in general for all of us, is how do we forecast and prepare for the future? And in terms of how prepared are we and how prepared are people in the region, Luz was giving us some of the global index data, and some of the recent estimates as well also show that from all the people who could come up, so it's possible for people in Latin America to access funds in order to cover an emergency. But what's interesting here is that only 11%, only 1 out of 10, particularly looking at the bottom of the distribution, can use some form of savings in order to cover an emergency, which means we have the networks, we have the resources, people rely on family, friends, access to credits, but in terms of savings, we still have sort of like a pending challenge in order to build that additional nest to cover future emergencies. And one of the things we believe, we hypothesize explains why people are not saving enough, people may not be prepared enough for those future risks, has to do with how we systematically underpredict our future expenses. What one piece of research has found, doing multiple studies with multiple groups of people, is that when they ask people to predict how much they're going to spend on different categories in the next week, in the next month, people on average underpredict those expenses by 15%. This is something similar to what I was mentioning about income. We think we're going to earn much more than we actually earn, and we think we're going to spend less than we actually spend. That's sort of like the biggest bias we have in predicting our income and our expenses. And what's interesting here is that when we think about predicting our expenses in the future, gig workers need to think about many things that could happen in the future. Most of them that are variable and that may change or not in the future. They need to think about how much maintenance they have to do to their different equipment, vehicles, bikes, motorcycles. They need to make sure they have enough data on their phones in order to be accessing the apps. They have also family expenses that they have to predict. And what research finds here is that we are very good at predicting sort of like those regular expenses that we typically have, but we fail mostly at predicting those unexpected and exceptional expenses. An accident, the bike breaks down, the car breaks down, we lose maybe some of the orders or which we had to deliver, so now we have to compensate for that. And while we might be better at knowing and identifying how much each of these expenses will be, we're bad at knowing how often these events will happen. So here the big challenge for gig workers is, how can we help them predict better or have a better estimate of how much they will need to spend in the future in unexpected things, in accidents that may happen, in different sort of like non-intended expenses, that non-expected expenses, so that they can have enough savings right now, or they can start building up those savings or use different insurance products in order to be prepared and be able to cover them when they happen. Because the alternative to having savings or to having insurance usually is using some form of credit, which ends up being costlier for people in general, relying on social networks, which could be sort of like a strong tool for some, but probably not for many of gig workers. So that's why one of the things we've been thinking about is how can we help them predict better these expenses. And what behavioral sciences shows and has done a lot of research about is around this concept of availability bias. So when we think about predicting our future expenses, one of the things that could be explaining why we fail to predict those expenses is this concept. Availability bias basically means that we judge the probability of an event happening based on how easily we can remember it or not, how easy it comes to our mind or not. So in the case of a delivery worker, for example, one of the things that could happen is a bicycle may break down, or the motorcycle may break down. If we've had one of those events very recently, it's more likely that we will think that it's an event with a high probability of happening. But if we haven't had any of those, if it hasn't happened to us before, it's more likely that we'll think, no, my motorcycle won't break down, or my bicycle won't break down. So we judge them as a low probability event. In both cases, maybe overpredicting, underpredicted, but never actually predicting precisely or closely to how it would often happen. So this is one of the levers we can try to move around to see how can we get gig workers to predict better, to have a better estimate of those expenses, and hence be prepared for those. And in that realm of solutions and helping people sort of like timely identify when is a good opportunity to save and what are some good things we should save for. One study that we did a few years ago at the lab as well that I think is relevant has to do with the concept of pre-commitment. So we also know that not only predicting those events is one of the challenges, we also know that self-control and sort of like the pressures of more immediate needs can also prevent us from saving for the future. Right? When you have to decide between, do I save for something that may or may not happen in the next couple of weeks, in the next month, or do I use this money for something that I need and then I have to do right now? We typically choose those immediate rewards and those present needs. So, but if we can get people to pre-commit to today for things that will happen in the future, hence putting money aside today for things that will happen in the future, it's more likely that people will be prepared to cover those expenses. In this case, we explore this concept of timing and try to identify when is it the right moment or not to get people to save. And we partner with a fintech called Digit, and what they basically do is they help people also set up make savings decisions using text messages tools, so they can interact with people make a decision, and then the fintech will automatically engage sort of like that savings decisions between people's accounts. And we leverage a particular opportunity in the US, which are tax refunds. So whenever every year, most people receive a tax refund, and we believe this is a good opportunity for people to save. The question we wanted to answer, however, is when is it better to ask people to save? Before you receive a windfall, before you receive the tax refund, or after people receive their tax refund? So what we did in this case, we sent two groups of people randomly assigned a message before they received their tax refund, or a message after they had already received it. And Digit had the possibility of checking their accounts and knowing whether someone had or hadn't received the tax refund. The interesting thing we found with this study is that across both conditions, about 10% of people saved some part of their tax refund. So it didn't have any effect on how many people ended up saving, but it did have an effect on how much each of these groups decided to save. So those people who received the message after receiving their windfall, they choose to save on average about 17% of the tax refund, whereas those who received the message before they had received the tax refund, meaning those who had pre-committed to save something when it arrived into their accounts, they saved an average 27%. So how this translates into gig work platforms, digital platforms, and what we can do with them is gig work platforms usually distribute some form of income to workers directly. So there's an opportunity to use those moments in order to help them decide, do they want to pre-commit to save a portion of that income for a particular emergency, for something that may happen in the future? Do they want to use part of their income to pay outstanding debts, for example? And timing it with that disbursement moment, similar to what we found in this study, could be one of the levers that we could try to test in the field to see if it translates into better financial decisions. So up to here, and before going back to Luz, who's going to help us wrap up the session and then open up the floor for any questions. I think the main takeaway from all this is that three things that we're trying to encourage platforms to do, and we want to test more of them in the field in Latin America, are how can we simplify and make those right decisions automatic and simple? How can we help gig workers establish new goals and then have different reference points that guide their decisions? And finally, how can we help people pre-commit for those future decisions and those future needs that they have to make? The environment in which gig workers are making these decisions or trying to build financial resilience is complex. And while these platforms have been a strong lifeline for them, we believe that exploring these behavioral aspects of those decisions could put them in a much better position to continue to thrive and for this to be a stronger network. And now back to you, just thank you.
Thanks, Hans, for sharing some of those really interesting insights and the deep thinking that you've been doing at the Common Sense Lab around, these common challenges for workers and entrepreneurs with your lens of behavioral science. We're going to open it up for questions in just a second, or go ahead and post them in the chat feature. But we just wanted to give you a flavor for how Common Sense has been putting some of these principles that they just went over to work with several digital platforms in the region to drive financial resilience. So, for example, they're encouraging short-term savings for ride-sharing platform drivers in Peru and Chile, and for small businesses in Costa Rica. They're trying to improve access to better credit opportunities through a digital platform in Mexico. They're enabling access to insurance products among rideshare drivers in Mexico, but also small businesses in Colombia with different types of insurance offerings. And so I think that challenges that we have ahead of us, with these large or new digital players, is proving out a business model for supporting financial resiliency. The idea being that if users of these platforms aren't financially healthy or resilient, that it's more, if they are more financially healthy and resilient, that it's more sustainable in the long run for your business. It's not just a nice to have, but an imperative. And so, and the second piece is around sharing out these types of lessons, involves policymakers and then also the plethora of platforms that are emerging. So these ideas around building in financial resiliency can really take root and scale. And we just wanted also to mention, the Common Sense Lab just released a new report that has many of these insights, and, goes into more depth on some of the case studies and tries to bring home these lessons and these challenges for these different segments. So please check that out. I'll put it in the chat as well. But let's turn to a couple of questions that have come in, and a couple of them are coming in Spanish. So I'm going to take a liberty and kind of try to translate them just in a broad sense. So the first question that's come in talks a little bit about, how do we help vulnerable populations make decisions that are rational and that have less cognitive bias? Hans, I'm wondering if you can talk a little bit about the scarcity mindset that oftentimes happens with, vulnerable populations, folks that are really living day to day. Tell us a little bit about that and how to overcome some of those types of mindsets.
Yeah, I think that's a great question and great segue to the concept of scarcity mindset. So what research has shown is that when there's a resource that we value very much, it could be money, it could be time, and we are in a situation in which that resource is scarce, we don't have enough of it, we tend to overly focus in that resource. So people that are living under poverty, or they usually face monetary scarcity, they are constantly thinking about that particular resource. And what thinking about it does is that it takes up most of their cognitive bandwidth and generates this effect of tunnel vision, in which because we are overly focused in that resource, we start neglecting other things that are happening in our environment, in our minds, and so on. That's good and has sort of like an adaptive purpose, because it helps us sort of like maximize and be even more strategic in how we handle the resource. But we end up neglecting other things that also affect us in general. So one of the things that research has also shown that can work in that when people are facing scarcity mindset is, if we know that it's very likely that, let's say, gig workers will be facing monetary scarcity mindset, how can we make those other decisions that don't have to do with money directly more simple, more automatic, establish better defaults so that they don't have to making those decisions. And in the absence of making those decisions, they end up in a good set. Things like, let's say, if people are overly focused with income, how can we help them automatically set up scheduled reminders for doing the regular maintenance to their motorcycle, or giving them additional incentives to give maintenance to their cars, to their vehicles, which it could happen that because they're overly focused on generating enough income, they're not thinking about how often they need to make those repairs in order to take care of the vehicle in the long run. Right. So what this means is making those other non sort of like tunneled decisions easier, simpler, automatic, and incorporating in part of the experience that gig workers have with the platform.
Awesome. So another great question that is very long, and I'll let people read it in the chat as well. But if I could summarize, and Hans help me out here, I think the essence of the question is around, like, how do we get around bad credit terms that are often offered sometimes via digital channels? Do you have any examples of maybe behaviorally informed interventions that are more in the inclusive finance track and could help kind of overcome some of these products that maybe aren't designed with resiliency and the worker in mind?
Yeah, I was reading that part of the question as well. And one of the aspects that we have been very interested in exploring more in general is how these different numbers that we get on credit offerings and credit cards influence our decisions. So the minimum payment, for example, or as you mentioned in the question, the maximum sort of like limit of how much you can spend or use, those typically are the numbers we are anchored to and that drive our decision. One particular study we did here at Duke University with student financing, for example, was what we realized is that most students were taking on the maximum amount of student debt that they were allowed by the financing officer. So let's say that if people qualified for $50,000 in loans, we saw that people were usually taking the maximum amount that they could. But in reality, when we talked with students and did a few surveys, we realized that they never actually needed to take on the maximum. And what was happening is just because the default was to take that maximum amount and the easiest path was to take that maximum amount, they ended up taking more debt than they actually needed. So the one redesign we tested with a group of them was guiding them, rethinking the process of applying for the loan so that they had to make more specific decisions about how much they needed for tuition, how much they needed for housing, how much they needed for food and so on, with some prompts to help them make those easier decisions. And in the end, the group that went through this process ended up reducing the amount of debt that they took. So this is a balancing act with digital credit and digital loans in general, because we know that people do value the practicality of accessing quicker loans, of simplifying access, but at the same time, we should be thinking about how we design this process in order for it to continue to be streamlined, to continue to be easy and accessible for different people, but at the same time putting enough guide rails in the process so that they are actually choosing how much they need and how often do they need to pay and how much they will end up paying in the future and so on.
That's really helpful. That's a really interesting, so relevant nowadays with all the student debt conversation in the United States. That's really helpful. There was a comment that came in that I'm going to kind of turn into a question, or just to see in some of your conversations with the Inter-American Development Bank and the Savings Laboratory. They've been doing a lot of this work for several years as well. And the comment was, you know, the lack of Social Security of gig workers increases the need to use app platform to provide Social Security type services, health insurance, and pensions. So, you know, you gave lots of examples on sort of increasing short-term savings for emergencies, which is obviously so pivotal, you know, especially after going a couple of years through the pandemic and the need for that. But have you seen any interesting interventions around sort of saving for the long term that you could share?
Yeah, this is a great topic, and we continue to explore it more and more. We have seen that what the IDB has been doing, and we think it's very interesting. They've been working with some of the retirement organizations in Mexico and some savings organizations in Colombia. And what they found is that sending people timely and very specific reminders can have an interesting effect on getting people to start making contributions to their retirement savings plans or to their savings accounts. The effect of those messages tend to water down in the long run. So people start becoming less and less sensitive to those messages. So that's why we think there need to be more. We want to test more structural interventions that are more embedded into the options that gig workers set up when they join the platforms and so on. And from a more policy perspective, which I think is part of what's on the comment as well, there is still a need, and this is something we'll be more than happy to keep discussing afterwards, but there's a need to make those different financial products and financial services, retirement plans, accounts, and so on, more flexible and adjustable to the way in which gig workers and independent workers manage their income. Because their income is usually very volatile. It changes from week to week. They at the most have a weekly planning on how much they want to spend, how much they want to generate in income. We've seen that they are driven by income targeting and other factors. So that income that keeps changing over time probably needs different financial services that can adjust also to those to that volatility in their incomes. So one thing we haven't seen, for example, is if there's a way for people to save micro amounts on every disbursement that they receive from the platform or from different providers, can they save a small portion of that every time they receive it for an emergency and then for retirement accounts? Retirement accounts are usually structured, at least from what we've seen in Latin America, more for formal employees with a payroll, with a monthly contribution to the account. whereas these workers need to make more daily or weekly contributions that continue to build up over time. So there's a need to rethink as well how flexible these products can be in order to adjust to those flexibles and complex realities that they have.
That's really helpful. So I guess underscoring the point that, taking some of the lessons in this work beyond, just the platform itself, but also to policymakers, how could they help sort of restructure the new realities of the digital economy? Really helpful. And I put in the chat, for folks, a copy of the new report that Common Sense Lab has put out on this topic that kind of summarizes those three takeaways and challenges, but also opportunities that I think Hans really showed through this presentation in a little bit more depth through that report. So we encourage you all to take a look and kind of follow the progress of this work. We're going to continue to be sharing, continue sharing out. So I think that probably will let people head over to their next presentation. This has been fantastic to be with you all. Really, thank you for hosting us at the Financial Inclusion Week, and we hope to hear more from you. Check us out, check out the report, and check us out at MasterCard Center for Inclusive Growth.
Perfect. No, thanks so much, Luz, and thanks so much to everyone for joining, and to Financial Inclusion Week and to the Center for Inclusive Growth for supporting our work in Latin America. And yes, we'll come back hopefully next time with some more specific results on what we're doing in Latin America. But thanks for all the engagement.